Welcome to this explainer. Today we're taking a completely data-driven look at a company that is operating quietly but absolutely powerfully behind the scenes of our modern financial ecosystem. We're going to do a complete business and financial teardown of Marqeta. We'll be looking at their business model, how their customer base is shifting, and crucially, digging into their newly released, milestone-hitting Q1 2026 financial data.
But first, I want you to just think about this for a second. Who actually powers the payments for your favorite fintech apps? You know, when you order a ride or get groceries delivered, or maybe split a purchase into 4 easy payments at checkout. There's this incredibly complex, invisible infrastructure making that magic happen in literal milliseconds. Well, Marqeta is the engine humming right beneath the hood of many of those seamless experiences.
Okay, let's dive into this. Here is our roadmap for today. 1. Meet Marqeta. 2. Powering embedded finance. 3. The profitability milestone. 4. Inside the balance sheet. And 5. An M&A target.
Section 1. Meet Marqeta, the API-first card issuer.
To really understand where Marqeta sits in the market right now, you have to look at their evolution. They started out issuing early prepaid cards, but they've morphed into this massive, global, modern card issuing platform. They essentially provide the plumbing. They allow other companies to issue their own physical, virtual, or tokenized cards completely seamlessly. And to grasp their true value, we got to define the space they absolutely dominate, which is embedded finance. So this is the integration of financial services like payments or lending directly into a non-financial platform's user experience. It's the whole reason a retail brand or a software company can suddenly offer you a branded credit card without having to literally build a bank from scratch. Marqeta provides the open API architecture that makes launching this stuff incredibly fast.
So who's actually relying on this tech? It breaks down into a few core use cases. First up, you've got the fintech giants, the ones offering mobile-first banking and instant liquidity, especially for younger demographics. Then, you have your on-demand platforms. Think Uber, DoorDash, Instacart. They need to manage massive amounts of gig worker payouts. You also have Buy Now, Pay Later, or BNPL, providers who use Marqeta to offer that instant credit at checkout. And finally, there's the enterprise expense management sector. This one is growing rapidly, with notable players like Ramp and Navon using the platform to completely automate corporate spend.
Section 2. Powering embedded finance, the platform at scale. And this brilliantly illustrates how Marqeta's evolving customer base is driving a massive shift in their revenue mix. Look at this 2025 data. Roughly 48% of their net revenue came from those massive fintech giants, but a solid 52% is now coming from other segments, with enterprise expense management becoming their fastest-growing cohort by far. They're basically shifting from relying on early tech disruptors to pulling in traditional banks and massive retailers who all want to embed finance into their own ecosystems.
Now, a huge reason these companies flock to Marqeta is a feature called just-in-time, or JIT funding. Think about a gig economy worker picking up groceries for a customer. Instead of the app preloading, say, $50 onto the worker's card, which obviously ties up capital and is a magnet for fraud, Marqeta's JIT funding authorizes and funds the exact amount of the purchase precisely at the moment the card is swiped at the register. It's a total game changer for risk mitigation and capital control.
Section 3. The profitability milestone. Q1 2026 earnings breakdown. The tech is clearly in high demand, and we are finally seeing that massive volume translate right to the bottom line. $112 billion. That's Marqeta's total processing volume, or TPV, just for the first quarter of 2026 alone. This is the total dollar amount of payments routed through their platform, and it is a massive 33% increase year over year. The scale here is just expanding so rapidly. North America is driving the bulk of it, but their international markets are acting as this really fast-growing secondary engine. A volume this staggering means Marqeta is capturing a truly massive slice of the modern digital economy.
Now, what's really interesting about this slide is how that volume translates to financial health. We're seeing really impressive year-over-year growth. Net revenue is up 19% to $165.7 million. Gross profit is up 19% to $117.5 million. But look at the bottom row. The absolutely crucial metric here is the flip from an $8.2 million net loss in Q1 2025 to a $7.8 million GAAP net income profit in Q1 2026. This right here, this is the profitability inflection point that investors have literally been waiting for.
And Marqeta CEO Mike Milotich framed this moment perfectly. He stated, "Our first quarter results demonstrate the power of our platform at scale as we delivered on our promise of achieving GAAP net income profitability, a testament to our strong growth and disciplined execution." Because, it's one thing to just grow your top-line revenue, but it's a completely different ballgame to execute with the discipline needed to bring that growth all the way down to the bottom line. And their operational efficiency really shines through when we look beyond just the GAAP metrics.
Their adjusted EBITDA surged a remarkable 66% year-over-year, hitting $33.3 million for the quarter. They even expanded their adjusted EBITDA margin by 6 full percentage points. This is a massive showcase of pure operational cash flow efficiency. It proves that as their platform scales up, the underlying cost to deliver those services is fundamentally sound.
Section 4. Inside the balance sheet, financial health check.
Okay, so profitability is a fantastic indicator of current performance, but a company's real staying power, that lies in its safety net. Right now, Marqeta is sitting on $674.7 million in cash and cash equivalents. In today's economic environment, where capital can be super expensive and honestly quite unpredictable, having over $500 million in highly liquid assets is huge. It provides them with an incredible runway for R&D and aggressive market expansion.
When we condense their broader balance sheet, the overall health of the company becomes even more striking. Look at this. They have nearly $1.2 billion in total current assets, easily covering their $721 million in total current liabilities. In total, they command $1.47 billion in assets against just $734 million in liabilities. We're talking about a true fortress balance sheet here. It is completely unburdened by heavy financial strain.
So the crucial point is their sheer lack of leverage. When you compare their massive $1.47 billion in total assets against their debt profile, there's virtually no long-term debt to speak of. Their long-term leases account for just $4.8 million. They are highly capitalized and completely unleveraged, which gives them absolute strategic flexibility going forward.
Section 5. An M&A target? The consolidation wave?
And honestly, because of that exact strategic flexibility, coupled with their new profitability, the broader market is definitely speculating about Marqeta's future. Industry watchers over at 24/7 Wall Street have pointed out that the fintech landscape is incredibly ripe for consolidation right now, and Marqeta's name keeps popping up. The macro environment is basically defined by a massive wave of consolidation. Major card networks want more control over issuance, large payment processors are looking to acquire sticky infrastructure, and private equity firms are actively hunting for profitable software companies that are trading at a discount compared to the crazy highs of 2021.
Let's move to and see how this builds a specific case for Marqeta. Why do analysts view them as such a target? Well, they just crossed that critical threshold into GAAP profitability. They're a pure-play, specialized card issuing rail certified in over 40 countries. Plus, their market cap is hovering around $1.6 billion, making them a very digestible acquisition for a larger player. They trade at a relatively undemanding 1.5 times enterprise value to revenue. On top of that, management is actively buying back shares. They spent nearly $40 million on buybacks in Q1 alone, which really signals confidence in their own underlying value.
Which leaves us with the ultimate question, doesn't it? Armed with this fortress of a balance sheet, incredibly robust processing growth, and this newly minted GAAP profitability, will Marqeta remain a fiercely independent infrastructure powerhouse? Or does this exact financial strength make them inevitably destined to become the crown jewel in a much larger fintech conglomerate's portfolio? It is a truly fascinating dynamic to watch, and one that is absolutely going to shape the future of embedded finance. Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.